Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sanmina Corporation quarterly report. Sanmina Corporation offers a wide range of businesses and services to various industries. At the core of its operations are two main businesses: integrated manufacturing solutions and components, products and services. Integrated manufacturing solutions encompasses product design and engineering, including concept development, detailed design, prototyping, validation, pre-production, manufacturing design release, and product industrialization. This business also offers assembly and test services, direct order fulfillment and logistics services, aftermarket product service and support, and supply chain management services. Components, products, and services is another key area of focus for Sanmina Corporation. It provides components such as printed circuit boards, backplane fabrication and assemblies, cable assemblies, fabricated metal parts, precision machine parts, and plastic injected molded parts. Additionally, the company offers memory solutions, storage platforms, optical, radio frequency, and microelectronic solutions. Sanmina Corporation also caters to specific industries with its defense and aerospace products, design, manufacturing, repair, and refurbishment services. Furthermore, it provides cloud-based manufacturing execution software. The company's diverse range of businesses and services makes it a significant player in the global market, serving original equipment manufacturers across various sectors including industrial, medical, automotive, communications networks, and cloud infrastructure. Sanmina Corp stock price skyrockets. A year of unprecedented growth, the past year has seen an astonishing 100% surge in Sanmina Corporation's SNMN stock price, driven by a combination of robust financial performance, strategic acquisitions, and surging demand in key technological sectors. The company's strong financial results and positive outlook for the first quarter of fiscal year 2026 set the tone for its remarkable growth. Sanmina's acquisition of ZT Systems, data center infrastructure manufacturing business from Advanced Micro Devices, Inc. AMD was a significant deal that bolstered its presence in the cloud and artificial intelligence (AI) market. This strategic move expanded Sanmina's manufacturing capabilities, including systems integration and liquid cooling, which are crucial for advanced data center solutions. The company's diversified market presence and strategic focus on sustainable and profitable growth have also contributed to its success. By focusing on end-to-end manufacturing solutions and reducing reliance on any single industry, Sanmina has established a competitive edge in the market. The increasing need for AI-driven hardware has positioned Sanmina favorably within rapidly expanding sectors such as cloud and AI infrastructure. While there was a temporary dip in stock price due to a weaker-than-expected sales forecast for the second quarter of fiscal year 2026, the overall sentiment and performance drivers over the past year have been overwhelmingly positive. As a result, Sanmina's stock value has skyrocketed, making it an attractive investment opportunity for investors seeking growth and stability. Sanmina Corporation maintains a market capitalization of $10 billion, broadly in line with the industry peer group. Sanmina Corporation trades at a higher price-to-earnings ratio of 41 times and a higher price-to-book ratio of 3.71 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The leverage on the balance sheet appears elevated, with liabilities of 57% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and operational factors. On the growth side, key contributors include the acquisition of ZT Systems, which has led to significant expansion in cloud infrastructure end markets. Additionally, new program wins and ramp-ups in communications networks and medical end markets have also contributed to revenue growth. Improved operating efficiencies and sales of accounts receivable under various programs have further boosted revenue. On the decline side, several factors are at play. Decrease in orders for CPS businesses, failure to recover tariffs or duties from customers, and transfers of business or operations between facilities have all led to a decline in revenue. Furthermore, U.S. trade policy, increasing the cost of using manufacturing services, has also had a negative impact on revenue. It is worth noting that some factors may not necessarily indicate a primary driver of revenue growth or decline, but rather potential future impacts on revenue. For instance, compliance with U.S. export control and regulatory requirements may lead to fines and reduced future revenue, while defective products and manufacturing defects can result in product recalls, warranty claims, and delayed shipments. The net income and profit margins of the company underwent significant changes between 2024 and 2025. The net income decreased by 24% from $65,003 in 2024 to $49,286 in 2025. This decline can be attributed to various factors, including reduced sales, customer disengagements, and increased competition among customers and competitors. The profit margins also experienced a change during this period. The gross margin decreased from 8.4% in 2024 to 7.6% in 2025. However, the IMS gross margin showed an increase from 7.9% in 2024 to 8.7% in 2025. This contrasting trend may be due to the company's efforts to improve its performance in specific areas. The reasons behind these changes are multifaceted and complex. The integration costs from the ZT Systems acquisition, potential loss of key employees, and changes in regulatory requirements affecting product design or obsolescence have all contributed to the decline in net income and gross margin. Additionally, adverse changes in key end markets and failure of customers' products to gain commercial acceptance have further exacerbated the situation. The company's financial performance indicates a positive trend in its operating cash flow. According to the data, the company generated significant amounts of cash from its operations. In 2025, the company reported an operating cash flow of $178,728 on page 6, which is a substantial amount. Furthermore, for the 3 months ended December 27, 2025, the net cash provided by operating activities was $179 million, as stated on page 33. This positive operating cash flow suggests that the company's core business operations are generating sufficient funds to meet its financial obligations and invest in growth initiatives. The consistent generation of positive operating cash flow is a key indicator of a company's financial health and stability. The company's debt level has undergone significant changes over the past year. Initially, both short-term and long-term debt saw substantial increases of 888% and 603%, respectively. However, a closer look at the data reveals that total long-term debt actually decreased by approximately $917,627 from September to December 2025. In contrast, interest expenses have seen a significant surge. The company's interest expense increased by an astonishing 390% from $5,001 in 2024 to $24,722 in 2025. This trend is also reflected in the data showing that interest expense rose from $5 million to $25 million. Furthermore, there is a potential reason for this increase, which is the unrecovered tariffs mentioned on page 41. Overall, while the debt level saw some fluctuations, it is the significant rise in interest expenses that stands out as a notable change. The performance of various regions and segments has been analyzed based on the extracted summaries. The Americas region stood out as a top performer, with revenue increasing by a significant 111% from $1,081,062 in 2024 to $2,281,974 in 2025. In contrast, the APAC region experienced a decline in revenue, decreasing by 7% from $695,573 in 2024 to $649,496 in 2025. The EMEA region also showed improvement, with revenue increasing by 13% from $229,713 in 2024 to $258,223 in 2025. The integrated segment and the components, products, and services (CPS) segment demonstrated mixed performance. While the integrated segment saw a substantial increase of 73% in revenue, the CPS segment experienced a modest growth of 5%. The Manufacturing Solutions (IMS) segment's performance was not specified in the summary, but its revenue was not mentioned as well. Management is optimistic about the company's outlook, citing plans to differentiate itself through end-to-end manufacturing solutions and global supply chain management expertise. This strategy aims to improve operations, build flexibility and efficiencies in processes, and adjust business models to changing circumstances. The company has seen significant growth in cloud infrastructure end markets, with net sales increasing by 59% due to this expansion. Management believes that the existing cash resources and other sources of liquidity will be sufficient to meet working capital requirements for at least the next 12 months. However, management also acknowledges various risks facing the company, including international operations, variability in operating results, dependence on a small number of customers, and changes in tax laws, trade restrictions, and currency exchange rates. These risks could impact sales, net income, and liquidity if not managed effectively. To mitigate these risks, management is focused on pursuing higher-margin business through its CPS businesses. However, this strategy depends on the success of these initiatives. Additionally, management is concerned about potential impacts from cybersecurity measures, environmental laws and regulations, financial accounting standards or policies, and climate change initiatives on revenue and profitability. The company's liquidity is also dependent on various factors, including profitability, business volume, and the extension of trade credit by suppliers. Management notes that increasing regulatory burdens and corporate governance requirements may impose costs, require significant management attention, and make it difficult to attract and retain qualified executives. Furthermore, the company faces liquidity risks if demand increases significantly or delinquent accounts rise, interest rate risk if high interest rates reduce net income and operating cash flow, and credit facility covenants that may constrain business growth through acquisitions or strategic transactions. The company has made several significant acquisitions and divestitures over the past year. In terms of acquisitions, the most notable ones include the purchase of ZT Systems for $1.62 billion in December 2025, as well as a joint venture with an Indian partner. Additionally, the company acquired ZT Group Intel, Inc., also known as ZT Systems, and its data center infrastructure manufacturing business from ZT Systems in October 2025. The acquisitions were likely made to expand the company's capabilities and presence in the market. The purchase of ZT Systems, for example, would have provided the company with access to new technologies and expertise in the field of data center infrastructure manufacturing. In contrast, the divestitures identified are more speculative, with the potential future sale of plants, businesses, or product lines mentioned as a possibility. This suggests that the company may be looking to streamline its operations or focus on specific areas of its business. The company has indeed engaged in share buyback activities, as evidenced by two separate instances mentioned in the provided summary. On page 22, it is stated that the company repurchased 0.5 million shares for $79 million in December 2025. Furthermore, on page 33, it is confirmed that common stock was repurchased, with a specific amount of $79 million being allocated to this endeavor. These transactions clearly indicate that the company has opted to buy back its own shares rather than distributing dividends to shareholders. This strategic decision allows the company to retain ownership and potentially increase shareholder value through increased earnings per share. Concerns about inventory buildup and supply chain disruption are evident in the recent data. Inventory levels have increased significantly, with a notable rise in raw materials and work-in-process inventories from September to December 2025. This is reflected in the $163,659 increase in inventories for 2025 compared to 2024. Furthermore, the amortization of inventory fair value adjustment of $49 million for the 3 months ended December 27, 2025, suggests that companies are struggling to manage their inventory effectively. The impact of supply chain constraints is also a major concern, with tariffs and import/export restrictions posing significant challenges. The data indicates slower inventory turnover and potential cash flow management issues, as evidenced by higher days in inventory 93 and lower net inventory turns 7. Supply chain disruptions have been exacerbated by inflationary pressures, higher interest rates, and trade policies. Additionally, work stoppages, labor unrest, and other external factors could further impact manufacturing and shipping of products. Overall, the data suggests that companies are facing significant challenges in managing their inventories and supply chains, which may have long-term implications for their operations and profitability. That concludes the financial summary for Sanmina Corporation. Feel free to comment below, and I will be happy to answer them when possible.